Sometimes companies will lend money with the expectation of earning a return on that lent money. So let's go through this example. It's October 1. We've got Sherlock Loans who lends money, $10,000, and they're going to lend it on they're going to issue basically a 5-month note, and the rate is 9%. Now I want to make an important point. Whenever you see an interest rate, it's always an annual rate. It's not a 5-month rate. It just means that if you were to lend the money for an entire year, the amount you'd earn on it is 9%. Now they're not going to earn a whole year because they're only going to lend it for 5 months. So this is really important. I'll show you in a bit. So everything's going to be due on March 1. So the company gets what they call a notes receivable. It's not a marketable security because it's basically a private note. It's not sold on in the marketplace. And what they give up is cash. You debit what you get, credit what you give. So that's what's recorded initially. Then at year end, which for this company we'll assume is December 31, the company has to make all its adjusting entries. Well, at December 31, the company is going to basically, it has earned money, is to receive more than the $10,000. So what we have to do is record interest. And at December 31, they've earned 3 months worth of interest. They've had, the money has been lent since October 1, so it's all of October, November, and December. And the way you calculate interest is it's P times R times T. The P is your principal, that's the $10,000. Now the rate is the annual rate of 9%. Now what the T is how much of that annual rate, how much of a year has gone by. And it's been 3/12 of a year, 3/12 of a year. So notice I'm not using the 5 in this formula. It's really important you don't use the maturity date in calculating interest, because basically your T is how much of a year are you recording of the annual rate. Now as far as the amount, it comes out to be $225. So what the company is going to get on December 31 is not cash. Adjusting entries are never to cash. So what you're going to get instead is called interest receivable. And what you credit is interest income or interest revenue, and that increases shareholders' equity. Now as far as when you get to the next accounting period, we're now at March 1, and the company is going to have to pay off the loan. They're going to have to, they're going to get their money back. So Sherlock Loan is going to get their $10,000 plus all the interest. Now the amount of interest that they're going to get is the 10,000 P times R, which is 9% per year. They're going to get a full 5 months worth, or 5/12 of the annual rate. So the amount of cash they're going to get is $10,375. So you're going to get $10,375. Now what they have to give up in exchange is they're going to have to give up this note receivable, and you're going to credit that. So that'll reduce your note receivable to a 0 balance. They're also going to get back their, or they're going to get the cash for this interest. So they're going to have to give up that receivable. So they're going to credit interest receivable for the interest they recorded last accounting period. That was 3 months worth. So they'll credit interest receivable because they're not going to receive it anymore because they're getting it here. In fact, they're getting more than $225. In fact, they got an extra $150. That 150 is the interest they earned in this new accounting period, not the prior. So what they're getting is they're basically getting cash for service they gave in January and February. So again, we record revenue in the period in which it's earned. So back in the prior accounting period, they had earned 3 months worth, and now this is the amount they earned in this current accounting period. So they're going to credit interest income, and that will offset the extra 150 here. So if you look at the entry again, our debits equal our credits. You're getting $10,375. You're getting your principal back. You're getting the interest that you recorded in the prior period because of accrual accounting, and you're recording the last 2 months, January and February, for a full 5 months worth of interest.